Hello everyone. I'd like to invite you this afternoon to join us on our webinar that is going to focus on our tax returns. It's that time of the year, so it's time for tax, and this year could be a slightly different year, as we know, for a large number of reasons. But yesterday there were meetings with Revenue and Government, and we are expecting, and it'll be down the line, some changes coming out of that. So those are expected. We don't have them to report to you today, but keep an eye out for them, and they will be coming soon. So putting together today, we were looking at this time of year when we all have to look at doing our tax return, and it's particularly difficult for all of you because you're doing everything. You're designing, making, selling, you're doing all your social media, and then to top it all, you have to go and do your accounts. And to that end, we are put together a webinar clinic. So if you have questions of a general nature during the presentation, please do put it in the chat, and we can deal with it either at the time or later. And then first of all, Donal is going to make a presentation. Donal's been with us a few times going through the accounting and the tax elements. And then Adriana Doyle is going to speak about herself and her husband's, Barry Doyle's jewellery business, and how they approach this aspect of their business every year, because everyone shares the same stress, and maybe this session will take a little bit of that stress away. If any of you have more specific, and we're not doing your tax return, by the way, but any more specific or challenging questions, we may take those offline afterwards. So I'm just allowing a couple of minutes for everybody to come on board. And with that, I'd like to introduce you to Donal. So Donal, could you kick us off, please?
Hello, of course I can. Yes, hello everybody. I can't be heard there. Gosh, can you hear me now?
Yes, Donal.
Okay, very good. So I'm going to put up a small presentation. Where's my play from the beginning? Okay, guys, so Donal Horgan is my name with HFS Accountants. We're based in Mountrathlin in County Laois, and we deal with, I suppose, what we would call the SME sector, the small and medium-sized enterprises. And I suppose this is the time of the year where I suppose we're busiest. It's our harvest season, I suppose. And it's the income tax return and the deadlines that are approaching on the 31st of October. So I'm going to start by just giving you a small bit of background as to the legal infrastructure, I suppose, behind the taxman, or what we would colloquially call the taxman or the Irish tax system. So we all have heard the expression the revenue commissioners, which is, I suppose, the colloquial term or the overall term for the taxman. But in effect, there's two main departments within the revenue commissioners. The first guys are the Inspectorate Taxes, and they operate in our tax districts. So for example, for people in County Laois, in Kilkenny, in parts of Tipperary, we all deal with the Kilkenny tax district. Depending on the part of the country you're in, will depend where your tax district is. But the role of the Inspectorate Taxes is to gather in information, make taxpayers make their assessments, register for tax. They would do the administration of revenue audits and inspections and so on. But it's effectively an information gathering body. That's the Inspectorate Taxes. On the other hand, the Inspector General, they're the money men. They're the people that collect the money. And they're the people, I suppose, we don't want after us, because they are very, very effective at what they do. And they have very strong powers in the situation where you owe the money, or can't pay the money, or don't want to pay the money, or are having problems making payments. They have quite extensive powers. So we want to stay away from the Collector General if we can at all. The Inspectorate Taxes, as I say, is there to collect information and get in returns. Again, we don't want to annoy the Inspectorate Taxes either, but I suppose if we can keep them both happy and stay away from the tax system as much as possible, that's, I suppose, what we want to do. Moving on to who has to prepare a tax return. And there's an expression in tax law, which is who is a chargeable person. And there's 6 main types of people that would fall into the category of having an obligation to file an income tax return. So the first of those, and the biggest body of those, are people that are what we call self-employed. So that's people like yourselves who work for themselves and do so to make a living. And they don't pay a stamp in the normal way. They don't be involved in the PAYE system, pay as you earn. And they're the main category of people in this chargeable person. The second type, and there'll be quite a few of these as well, are people that work in the regular employment system. So they're PAYE workers, but they have an additional source of income. So maybe they have a small investment, or a big investment for that matter, or maybe they have a rental income coming in, or something that would be defined as an income outside of the PAYE system. And again, that group of people have an obligation to file an income tax return each year. The third category.
Donal, may I interrupt you for 1 second?
Yeah.
Do you have the screen to share with us, or will we send that later?
Oh God, are you not seeing what I'm seeing? Oh, obviously not. Oh, sorry. I'm sorry. I thought I had shared this.
No.
Oh,
just take a few seconds. You can just wind back a little bit if that helps.
Sure. Well,
yeah.
Why is this not showing? Gosh, my apologies. Okay, I can see myself now. Oh, share screen. Now, how's that?
It's coming. Good. Oh, brilliant. That's great.
Okay, sorry, my apologies.
Back to the beginning.
Okay, back to the beginning. So round 2.
Thanks, Donal.
Right. Okay. So as I was saying, the tax system in Ireland, we've got 2 main, two branches of the taxman, if you like, in the tax system. There's the revenue commissioners, is the overall term. The Inspectorate Taxes then are the people that gather in the information. So they're the people responsible for collecting your income tax returns. They administer the registrations for the various taxes, and they conduct audits and so on. The second body are the Collector General, and again, he's the money collector. He's the one that we don't want to upset. Well, we don't want to upset either of them, but in particular, we don't want to upset the Collector General. So getting on to who have to return income tax returns every year. And again, as I say, there are six types. The first are the self-employed persons. The second, the PAYE people that have an additional source of income. The third are the company directors. So if you are, the term is a proprietary director, and a proprietary director is someone that owns 15% of their own company. So if in a lot of cases in Ireland, you'd have 2 spouses, so a husband and wife might own a company 50-50. So they would be proprietary directors in that they own more than 15% of the company. And even though their income might be entirely from that company and they have no other source of income, they are still obliged to file an income tax return. The fourth category of persons are those that have foreign bank accounts. And again, this would be a smaller number of people. Number 5, then people with foreign life policies or foreign properties, they have to file an income tax return. And lastly, those that have had capital gains in the year. Now, I suppose a capital gain might be if you were to sell a property or if you sold shares, they'd be the kind of things that we would consider capital gains if there was a taxable element to it. So any of those 6 categories of people are required each year to file an income tax return. Now, the deadline date and the date that's fast approaching us is the 31st of October. So on the 31st of October each year, you must file your income tax return for the previous year. So in the case that we're sitting in, we're looking at the income tax year of 2019. We are due to file and pay on or before the 31st of October. Now, there are some rules with regard to the commencement of a trade. So if you happen to begin operating as a sole trader in 2019, your year of assessment won't run for the full 12 months. It will run from the date of commencement up to the end of December. So you'll have a partial year. And then there are different rules for the second year of trading and so on. But to keep it simple, for most people, it's your income in the full 12 months of 2019 And if you're self-employed, you'll prepare accounts for that period and report accordingly. Now, the payment element of what's owed for taxes is complicated by a thing called preliminary tax, which we always struggle to kind of explain, especially to first-timers. Preliminary tax is, I suppose, an estimate of how much tax you will owe for the current year. So even though we're filing your tax return for the historical period 2019, we will be expected to pay an amount in respect of the current year 2020, and that's what we call preliminary tax. And preliminary tax is based on one of three calculations. It can be 100% of the previous year's liability, so that's 2019, or it can be 90% of the current year liability, or 105%. I might have to go on a page there. Oops, sorry. Oh, 105 of the pre-preceding liability, and that just means 2018. But only that option is only available if you're paying your income tax by direct debit. So preliminary tax can be a little bit unfair. People consider it very unfair because they think they're having to pay tax early. But if you compare yourself as a sole trader as against somebody that works in the PAYE system, it isn't terribly unfair, because those in the PAYE system, you know, if they're paid every week, they pay their taxes every week, and if they're paid every month, they pay their taxes every month. So there is an element of catch up in preliminary tax because you've paid no tax in respect of the current year. I can't get rid of these. Let me see. Oops, sorry. Now the deadline for the 31st of October is extended. This extension came in a good few years ago. I suppose they were trying to wean us off the old paper returns. So the 31st of October was the kind of paper return date, and they gave us an extension, which is now to the 12th of the following month, the 12th of November. But this is where two conditions are satisfied. One is that you file on or before that date, and you pay in full on or before that date. Now, anybody that misses that date of the 12th of November, so there is a very harsh 10% surcharge that is applied. Now, Emer had mentioned it at the beginning of this presentation. There was a meeting yesterday with the tax authorities and the profession, and it is expected, although it hasn't been announced yet, but it is expected that that surcharge will be eased in light of COVID. And we are kind of expecting that there will be no surcharge if all filings happen within a month or two of the 12th of November, which is the current legal deadline. And we expect that the 10% might be reduced to 5%, but that will become clear in the days to come. We're not entirely sure just yet. Now there's a little example here of preliminary tax based on the different years. It can be a difficult concept to get your head around, but in effect, if you start out in 2018, you will pay no tax because you haven't calculated your accounts yet, you haven't filed an income tax return, and you won't do so until you get to 2019. And when you get into 2019, you're going to pay whatever is owed for that year, plus preliminary tax into the following year. So if you look at the bottom line on that table, in 2018, you'll pay nil in the first year, 2,000 in the second year, and 1,000 in the third year, and thereafter 1,000. That would be where your profits determine an annual tax charge of €1,000. It's kind of, you pay nothing in the first year, and then you pay a double charge in the second year, and then you're back to 1 year every year thereafter. But as your profits rise and fall, preliminary tax can have quite an impact on your cash flows, and it can come as a nasty shock, particularly where profits are increasing, because you're having to pay effectively a double whammy on higher profits. So it can be, and it can play havoc with our cash flows. So in preparing for your tax return, the sort of information and the sort of things we need to get is obviously our sales and then our costs. So we want to establish the difference between our sales and our costs to give us our profits. And it's only on profits that we are subject to income tax. So a lot of our costs, particularly when we start out, a lot of our costs can be, I suppose, partially personal and partially business related, as in the phone. And it can be difficult to establish how much of a particular cost is business related and how much is personal. Now, in tax law, the taxman will use the expression, in order for a cost to be business related and to be allowed as a deduction against your income taxes, it must be what they say wholly and exclusively incurred in the purpose of the trade. Now that's very unfair, because most of us will have a phone and we'll use the phone for both business and personal purposes. And if we listen to that wholly and exclusively, if we took that entirely, we wouldn't be able to allow any of the phone. But I mean, all accountants will allow a degree of the phone. The trick to do is to remember to disallow a portion of the personal expenditure that you estimate of your phone or your light and heat or whatever your cost might be. The other thing to bear in mind is the very last point there on this slide, which is pre-trading expenses. So if you officially start trading on the 1st of January 2019, you may have incurred costs in preparation for that trade, and those costs will be allowed once they are incurred within 3 years of commencement. Now, in your tax return, there are a couple of technical things. I mean, again, what most people will come across is their trade income. So this is what we would call our profits from our trade, and they are taxed under what they call, this is now under tax law, Schedule D Case 1. Rental incomes are Schedule D Case 5. Deposit interest, Schedule D Case 3. And all other income is Schedule D Case 4. Employment incomes are what they call Schedule E, and that also includes social welfare. And dividend incomes are Schedule F. That, look, none of us really need to understand that or know that. It kind of means nothing anymore. It just determines, I suppose, which box you fill in the figures. One thing to note, I suppose, and to be careful of, outside of your normal profits or incomes, the sort of things that are allowed as deductions are pensions. And a pension can be a very useful tool as a way of, I suppose, reducing in effect the amount of tax that's owed, because it is effectively deducted from your income tax. And what's also allowed is you're allowed to make a deduction if you make a payment into your pension up to the 31st of October 2020. So I suppose if you prepare your accounts and you determine your tax bill is fairly high, and if you have a few bob sitting there, you could invest in your pension. And even though you're only making that investment in 2020, you can avail of the tax relief in 2019. Nursing home fees and unemployed carer fees are allowed at the upper rate of tax. So in other words, the tax relief can be applied at the 40% rate if you're lucky enough to be earning income in that rate of tax. Also maintenance payments that are court mandated. So this will happen in I suppose in a marriage breakup situation, or where couples separate, where the maintenance agreements are court mandated. They are allowed for if spouse A pays to spouse B, they are deducted from spouse A and they are added to spouse B. So they become taxable in the recipient's tax return. Now, there are a good number of different tax credits that are available. You'd really want to check with your agent or your accountant. Are you getting all of the reliefs that are available to you? But there's quite a few of them, and they're all of different values, and they all have their own entry criteria. So what I'd like to do, that's my little bit of theory on the income tax. I'd like to run you through an actual income tax return just to show you what it looks like, and point out the kind of types of information that goes into a tax return, if that's all right. So if you give me 1/2 second now, and I'll try and find it. And this is causing me more trouble than it should. Last year. Sorry, guys.
Okay. Donal, will you take questions on the tax return as you go through it?
Oh, I will, of course, yeah.
Okay, thank you.
Okay, so you should be seeing a tax return.
No, we've still got the preparing my tax return for 2019. So got your personal credits up there.
Okay, that's not right. God, I thought I knew how to operate this system.
You did. You did the last time.
I'm having a look today. Right, share screen again now. Okay, here we go. Now are you seeing the tax return?
Yep.
Yeah.
Thank you.
Okay. So the actual personal income tax, it's known as a Form 11. So if anyone want to Google a Form 11, you will get this horrible 24-page paper return that you're very welcome to fill in. But Revenue prefer now if we file our returns online. So there's the Revenue Online system, or ROS, that we all have access to, or you're all able to get access to, and you can fill in your tax return on it. But this is the sort of detail that we want on an income tax return, typically. And it'll start with your personal details, so your name, your tax number, your date of birth, and so on. And if married, it will ask for your spouse and the details of your spouse. And then it will go for your residency and your domicile, which is a legal situation. It's effectively just where in the world did you come from and what your nationality is. So that's all pretty straightforward, I suppose. The first part of an income tax return then that we fill in would be our self-employed income. And again, we start by giving revenue our profit figure, or our taxable profit figure, which will be nil in the case of if losses are made. And then we get what are called capital allowances. And capital allowances is really tax speak for what we would know in normal life is depreciation. So accountants will give you depreciation off your capital assets, whereas the taxman will give you capital allowances. And they're much the same thing. Capital allowances are given generally at 12.5%, whereas the depreciation rates might be slightly different depending on your type of business. So next we're going to tell the revenue of the period in question. So in this particular case, we were talking about the calendar year, 1st of January to end of December. And then we give a small bit of detail in terms of our profit and loss account. So our sales and our gross margin and our various operating costs. And we kind of reconcile back to our profit and loss account. So the figures that we're going to look at are going to be by and large the same for most people, I suppose. The sales figure, the cost of sales figure, your stock figures, and then your various operating costs. And then we give a snapshot of your balance sheet down here. So your stock, your debtors, your cash, your bank situation, creditors and loans. And again, the figures returned in this Form 11 should tie back to a set of accounts that you have prepared earlier. So we're like the people in the cooking shows. Here's one I prepared earlier. The next source of income that many people will have is rental income of some kind. And there's two types of rental income. I suppose there's residential properties and I suppose everything else. So if you have a rental income, this is the part of the tax return where you inform revenue of that income. The next source of income that most people will have, or some people will have, is within the PAYE system. So anybody that has an employment, the figures will be put in here. So we will put in what the gross pay was and how much has been deducted from you, because obviously you're credited for any tax that you've paid during the course of the tax year. Then if we go down through it, we're coming on to the, I suppose, the things that are more or less common, shall we say. Sorry, I will say under that box, PAYE, BIK, pensions 2, that's the area where we'd be filling in any social welfare. So if anyone was in receipt of, I suppose, job seekers or any of the carers allowance, those sort of things, that it's in there, they would go. And then we've got the other types of income, foreign incomes and so on. And then we, I suppose, as we go down and progress through the return, we fill in what our various tax returns and tax credits are. Then there is I suppose, the less usual, the capital gains and capital acquisitions that may have happened. That would be less usual, shall we say. And in the end, the Form 11 will give you, under column A, it will give you a revenue assessment. So revenue will calculate your tax for you. But column B is for you to fill in yourself. Now, what the vast majority of people, and I think everybody in my experience anyway, everyone will accept revenues calculation. But remember, this tax return is done under what we call the self-assessment system. So this is your tax return, and it is up to you to tell revenue how much you owe them. So you can change the figures. In column B, you're putting in what you think the figures are. So you can say you think revenue are wrong. Now, I wouldn't advise it, but you know, you're welcome to do it if you so wish.
Donal, we have a question in. If both spouses are self-employed and assessed together, do you complete only one Form 11 or two, one for each?
Well, I suppose I'm going to drag you back up here to, it depends on the basis of assessment. Where a couple, a married couple can choose to be what we call jointly assessed or separately assessed. Now, this particular tax return was done under the self-assessment, and that's, I suppose, the normal situation. That's where both spouses' income are added into the one tax return, and you would have effectively two trades. So you'd have trade number one, that might be her, and trade number two, that might be him. Or I suppose in this day and age, you can have trade one her and trade two her, or trade one him, or trade, it's all very funny. But the self-assessment is carried out under one of the spouses' tax numbers. And one of them has to make an election to be the assessable spouse. So one of the couple just decide the tax returns are coming in under my name or my tax number, and that's the way it stays, unless they choose to be separately assessed, in which case they'll put in two separate tax returns and one won't refer to the other. I hope that answers that question. The end of the tax return then, I suppose the last thing we're doing is we're doing a declaration to revenue that this is true and fair. And I suppose the very bottom of it is a signature page. So this I mean would be all tax agents, all accountants would demand your signature on a paper form before it would be submitted to revenue, just for fear that there would be arguments or problems down the road. It's the, I suppose the thing to remember, this is your individual tax return. So if an accountant is filing on your behalf, they're filing as your agent, but that is your tax return. And I suppose ultimately the taxpayer has to take responsibility for all of the information contained within the tax return. So I suppose that's about 25 minutes, guys.
Donal, thank you for that. I mean, I know this is a how long's a piece of string question, but would you say is a time limit? I mean, to be sort of fair to either your agent or whoever's helping you do this return, would you say to get the books to you at the latest in the next 2 to 3 weeks, or? Oh,
absolutely, yes. Look, at all accountants at this time of the year are going to be coming under more and more pressure, and the sooner you can get them in, it's going to be an enormous help. I mean, remember too, you know, if we're doing your tax return and we're coming along to tell you guys we need 500 euros to pay the taxman, or 1,000 euros, or 10,000 euros, or 150,000 euros, the more time you've got to kind of arrange where the money is going to come from, the better. So it's in everyone's self-interest to get this done as quickly as possible. So I would say don't delay. Get whatever you've got ready, bring it to your agent as soon as you can. And if you don't have everything, fine, at least let them get going. So I would strongly urge you to get stuff in as quickly as you possibly can, because look, we're only 6 or 7 weeks from deadline. And I mean, I know we're expecting maybe we'll get some sort of extensions because of COVID, but it's in everyone's interest to get in sooner rather than later. And again, a lot of accountants will be paying staff overtime. You know, it's going to be far more expensive for them, and that's going to mean it's going to be more expensive for you guys. So don't delay. That's my.
Okay, so even if you're only partially sort of 50% there.
Oh no, give it in. Let someone let them get going.
Okay,
and use the technology that's out there. So for example, a lot of guys will come into us with paper bank statements, and look at, I don't want paper bank statements because they're too hard to work with. If you can give your codes, now again, people will misinterpret your codes, but if you can download your bank transactions through the banking software and give them to your accountant in a kind of soft copy, you know, a CSV file, it's much easier for the accountant to work with an Excel type document than it is with paper or PDFs. Because the first thing they've got to do is pay somebody to type those paper documents into a computer. So if you can give the information in the format the accountant wants, it speeds up the process. It leads to greater accuracy and a reduced cost to you. So use the technology that's out there if you can. There's lots of accounting software that's quite reasonably priced. There's a lot of innovation in things like Receipt Bank, which is a piece of software that allows you to take photographs of your maybe your traveling expenses or your invoices for that matter, and they zoom up into the cloud and they get coded, and it kind of cuts out the bookkeeping, it cuts out the need to keep paper because we keep a PDF record of the purchase invoice.
Okay, we have a couple of questions here. If you scan your receipts into an accounting program on the cloud, do you still have to retain the actual paper receipts?
No, I would say no. If you've got a PDF of it, I would say that's fine. No, absolutely, yeah.
Okay, online accountancy services have been recommended, i.e. pay less tax. How easy are these to use?
I've never used them, so I can't honestly say. I couldn't answer. I would imagine they're good, but I've never used them, so I can't say.
Okay, here's two little interesting ones here. They're more sort of tax advice. Is there a benefit to being assessed together, and what interest can you claim on rental income?
I would say, firstly, yes, I would say there is a benefit to being jointly assessed for tax, because it means you can avail of each other's tax credits to some degree, and if there's different levels of income, one person in the relationship, or one person in the couple might be earning tax or paying tax rather at the higher tax bracket, and the other not so. So if you share your tax allowances and tax brackets, it can be much more beneficial to both parties. And also you can look back 4 years. The taxman will not allow you to look back any further than 4 years, but you can look back as far as 2016 at the moment. 16, 17, 18 and 19 are the 4 years. So if you haven't, do and have a look back at your combined tax situation if you haven't previously.
Okay.
So yeah, I would go with that. Now, in terms of rental, what was the question on rent?
Oh, they wanted to know the interest. What interest can you claim on rental income?
What interest can you claim? Oh, in terms of your mortgage?
I presume it's mortgage or against the income.
Yes. Yes. Okay. The landlord now, if the landlord has a rental income in, they are allowed the mortgage interest against that income, but they're not allowed the capital element of the mortgage payment. So if you're paying, for the sake of argument, €1,000 a month in a mortgage payment, the likelihood is most of that is paying the capital loan as opposed to the interest element, and only the interest element is allowed as a taxable deduction.
Okay, I'm a sole trader who just set up this year, but I've paid €500 voluntary contribution for the last 2 years. How would this affect my tax return?
Okay, 500, that sounds like a PRSI. I'm sure you've all heard the expression of a stamp, a PRSI stamp, and 500 quid is the minimum PRSI charge. It sounds like you've paid a PRSI voluntary stamp, which will have long-term benefits in terms of pension entitlements, it's another thing that she may be referring to is she may have paid preliminary tax and she's got €500 sitting there in respect of the tax year. But until you file the tax return, you don't determine how much tax is ought to be paid in full. So it could be sitting as a kind of a payment on account, but it sounds to me like it's a PRSI stamp that you've paid. That's what it sounds like.
Okay, I have another one. I'm going to summarize this one. This person's looking basically for what percentage of their light and heat can they claim when working from home?
Oh, how long is a piece of string? I would say light and heat, probably not much. You know, I mean, in the building that, you know, depending on the building, I'm assuming it's not a 300 room house and you're operating out of one of them. But, you know, what would it be? A 2 or 3 bedroom house? You know, 10%, 20%?
And would 20% would kind of be acceptable?
I would think 20% would be fine. Yeah. I mean, oftentimes the mistake we made is that we try and say, well, 90% of it is business related, and that's clearly not the case. So I don't think revenue would have a problem with 20%.
Okay, thank you, Donal. This person, it's my first time filing tax return.
Mm-hmm.
I'm also in part-time employment.
Yeah.
So is it the same Form 11?
Yes, it is.
That I fill out?
Yes.
Okay, and can you give any hints to the person who's doing this for the first time?
Oh, don't be afraid of it. It's just a form like any other, you know, just find the box that's relevant. And if in doubt, there is an expression of doubt box. So if in doubt, tell revenue, you're not sure, you know, and they will come back to you. You know, and look, even if you, God forbid, you make an entire mess of it and you overpay your taxes, you know, you can go back and revise. You know, the revenue don't expect you all, you know, they don't expect you to get it right 100% of the time. You know, you're entitled, you know, you're allowed to make mistakes. It's not catastrophe altogether. You know, if you have to make a change, make a change, and you put in an amended return in the future.
Okay, Donal, thank you very much for that. I think we've exhausted you for now, and I'd like to welcome Adriana as a maker herself to have a chat with us about her experiences of this time of year. Thanks, Adriana.
Thank you. Thanks, Emer. Good afternoon, everybody. Hi. Thanks for that, Donal. It was really helpful and informative, as useful, as always. I'm just going to share my screen here, if I can. Time for tax. When Emer asked me to speak about this the other day, I thought, oh, really, Emer, can I not talk about something like export or things that I really enjoy? Because let's face it, none of us really enjoy this. It's not something that any of us have. I tend to procrastinate about it, something terrible. So what I will say to introduce myself, first of all, I am one half of Doyle Design Dublin. My husband and I are designers, makers. We have our own bespoke jewellery shop. It's behind me here in the centre of Dublin. We've been in business for about 20 years now, give or take. That's the two of us there. So we have a few different retail aspects to our business. We have our retail, we have our online sales, we have our own like bricks and mortar shop. We've two little shops at the moment, actually, and then we have our wholesale, both domestic and international customers. So every year I have this fresh hell of doing tax returns. So I'm very familiar with it, but we do have an agent and a chap who's you know, who does all that work for it and actually files the returns for us. But what I thought when I would just share with you things that I have found helpful, maybe do as I say and not as I do, because I tend to be the real procrastinator with this. So what I was thinking about, the things that popped into my head as we were talking about, like Emer and I had a conversation at the beginning of lockdown about how it would be a really good idea to use the lockdown time to do your tax returns. Did I? No, of course not. But I did get a little further ahead than I would ordinarily be. And that image that I've shown there is kind of where I used to be at this time of the year, with stuff piling up around me and being way behind it. So what a wise person told me a long time ago, to do a first hour of every day just catching up on some paperwork, which makes perfect sense, really, is when you, because it's very difficult to be, I think, a creative when you know later on in the afternoon you're going to have to do some paperwork, or you know on Thursday or Friday you're going to have to do some paperwork. So if you just spend a couple of, or an hour, half an hour every morning just getting on top of stuff, it really does help in the long run. And as Donal was saying, there's a kind of a, like when you're making something, here's one I made earlier, I'm kind of working from the backstory of it when you're putting together all your paperwork. Keep receipts for everything. I think if you can get into a habit of just every time you hand over money for anything, get a receipt for it, because not all of it obviously is going to be allowable or deductible, as they say in the States. But if you don't have the receipt, you've no chance of claiming for it, and you can always check with your accountant or your agent to see if it's valuable and if it can be used. I would also say treat every invoice, this is a habit I got into, treat it as though it was a €50 note, because particularly if you're VAT registered, there's money in it, and you can deduct off what you do owe for. So just treat every invoice and every receipt as though it was valuable, or it was actually like a little bit of a piece of like an actual note itself, a 50 or 20. I would say another thing I often do is scan back through your bank and your credit card statements with regularity or monthly, just to see if you're missing out on any kind of allowable expenses. But what happened a couple of years ago to me was I decided that I was actually going to go and do a weekend course in filing your own tax returns, because I can think of easier, nicer ways to spend weekends, I can assure you. But what I decided to do was, what happened was we got a massive tax bill one year, a few years ago. And when I went back through the Form 11 and back through everything, I realized that there was some things that could have been put in as expenses and they had been put in as drawings by the accountant. The accountant had decided what way it was going to be filed. So I decided, right, I'm going to go and do this tax return, how to do your own tax return. And I just share with you a couple of things that I learned from it, and Donal will give you the specifics because I'm no tax expert, but there was these few things that really resonated with me when I was at this particular course. And one of the things the chap said when he started was, accountants are really, really busy people, and they're not going to hold your hand and walk you through every single thing that you are able to deduct or able to claim for or able to change or to is allowable. So you need to really be, responsible for yourself and responsible for your own paperwork, and be prepared to ask the question, can I claim for this? Can I deduct this? And check it out yourself and be aware of what's possible and what's not. He also defined what an expense is. Now, I'm not even going to try and define it for you. Donal will be the one who would be able to define it for you. But what I learned out of that was, if you can start to think differently about how you're generally always working, particularly when you're self-employed, you're generally working 24 hours a day, 7 days a week. So there are ways that you can incorporate your work into your life, that you can use expenses more wisely, or you can just be a bit more clever, but now obviously legally, but you can just think a little differently about how you work and be more effective and efficient with it. There was a thing called subsistence, which I knew nothing about. Now, Donal will define this for you and what it is and how you can claim for it and, what the legalities of it are. But for every so many hours that you're away from your desk, you can claim a certain amount of money if you're a limited company, I think is the definition of it. But I'm sure Donal will clarify that for you. You can employ a family member once they turn 16 for very, very little income tax. And I currently have now employed our 16-year-old daughter who's starting to do our paperwork for us, which is really handy. So if any of you are in that kind of a position, it might be useful. And again, Donal can clarify. If you're newly established, and this was something that came up in that room that day, was that if you don't add in very many expenses in your first year, and then in your second year, you start adding in a lot of expenses, it can raise red flags for the revenue. So it just might be worth your while just making sure that you are claiming for all your expenses in your first year of trading. And again, I'll defer to Donal on that. And medical and dental, they're hugely effective. Please keep all your medical and your dental records. Not everything is claimable for, but just for example, last year we had several braces and root canals and serious medical bills in the family, and I ended up being able to reduce our tax bill by €3,500, which is a significant amount of money. So keep all your receipts for everything and make sure you're claiming for all your allowable medical and dental. And that's about all I have to share on the subject at the moment, and good luck everybody.
That's great. Donal, would you like to take up those clarifications and queries?
Yeah. I would agree wholeheartedly in terms of the subsistence. Now, subsistence, it doesn't work so well for self-employed persons, but I suppose the main civil service, the main subsistence that we would know is what's called the civil service rates. So if you work for a government body and you sit into your own car and you go on a business trip up to Donegal, you don't expense the €50 diesel receipt that you get for the trip. What you do is you expense the number of miles that you traveled, or kilometers as it is, and you pay yourself around some amount. That's, what is it, 50 cents a kilometre, I don't know, 60 cents a kilometre, I can't remember now what the rates are, but they're more lucrative than the actual diesel receipt that you might get. And the reason for that is there's an allowance for the wear and tear on the car, and the tax and the motor insurance and so on that you have to have on the car in order to get you there. You're allowed then, if you're out of the office for more than 5 hours, you're allowed a lunch allowance. If you're out of the office for more than 10 hours, you're allowed a dinner allowance. And if you're on an overnight, you're given an overnight allowance. Now, these allowances have the advantage that you don't need to produce receipts. All you need to be able to do is show that you were on the trip and you spent that time away from home. And there is a distance category. You have to be further than, again, it's 30 kilometers, I think it might be, from the office. I can't remember the exact specifics off the top of my head. 20 kilometers it might be from the office. So the subsistence over the course of a year can grow hugely, especially if you're a mobile sort of person and you're doing lots of traveling. It can be a huge amount, and can be a very tax efficient way of, I suppose, making a few bob, because it's generally the subsistence payments would be more than the actual costs. So if you are a self-employed director operating through a company, then the subsistence sheets would be very important. But it is very important to keep records, dates and times and reasons for travel, because revenue are sticklers for having proper expense sheets properly receipted. Self-employed people can look at a percentage of motor expenses. I suppose, you know, your diesel, your repairs, your tax, your insurance. Again, we got to remember to disallow a portion for personal spending. And usually we'd be looking at a minimum, maybe 20% you would disallow of these expenses that would be determined as personal. But subsistence, definitely, again, if you go to the great Google and you Google civil service rates, it will give you the amounts paid under the different categories, and they can be particularly if you're doing a lot of traveling, it can be a really beneficial to you. The second point there I want to mention is employing the family member. Absolutely 100%, we should all be doing it, because again, if you've got a son or a daughter, they've got tax allowances and reliefs, and they can earn, you know, up to 10 grand maybe tax free. It's not that they're not in the tax system. They are in the tax system. It's just they don't earn enough to fall into the tax brackets. So it is a way of I suppose, bringing income into the family. So I suppose the parent might, on that 10 grand, pay 50% tax, which would be 40% income tax plus USC plus PRSI. Whereas if they pay that 10 grand down to a child, it could in theory end up being tax free. So it's a €5,000 saving over the two methods of taxation, and it's entirely legal, and there's no issue at all with it. I'm getting notes here now. I'm getting prompted here. My expert in the background is coming in. Just make sure it's normal pay for the normal. In other words, you're not going to pay someone 10 grand for doing 3 hours in the summer. You know, they kind of have to earn them, you know, so make sure they work every weekend, or they do a Saturday every weekend, and you'll be fine. Now, the next point then on just making sure you log all your expenses, and again, red flags are something that Revenue watch, because I mean the advent of computer systems now, I mean Revenue do an awful lot of analytical, so they're analyzing your figures, and they're looking at your business up against similar business types, and they're trying to see trends. So they will expect, you know, for your type of business, that your motor expenses will be something similar to somebody else. And if they're not, they'll ask the question, and they might knock on your door and make more extensive inquiries. And again, we don't like Revenue making extensive inquiries of us. We would rather they stay away from us. So we don't want to give them any reason to have a red flag on us. Also, a common mistake people make, particularly in the early years, and in the early years of business, and maybe you're not making money and you're in a loss-making situation, and you don't want to tell Revenue you made, you know, so you kind of, you don't put in expenses so that you're showing a modest loss, maybe rather than a big loss. But remember, in income tax law, the losses have to be made good by future profits before those profits become taxable. So if you lost, for the sake of argument, €1,000 in your first year and €1,000 in your second year, well, then the first €2,000 that you make in your third year are tax-free, because you've got to cover those losses first. So if you're making a loss, don't be afraid to bump it up, because the taxman will in the future give you some sort of some little bit of tax relief on those losses. And again, medical and dental 100%. And the only real thing that are disallowed in medical dental situation would be cosmetic type work. Pretty much everything else is allowed. So yeah.
Donal, I have a question in here. There's a person who has a handful of invoices from 2019 and 2020, or 2020 she doesn't have to do it next year, and very few expenses. Would it be difficult to do the tax return herself?
Well, I mean, I would say not, but I mean, I suppose the question has to be asked. If you ask me to make a hat, I'd, you know, I'd make a hash of it. You know, I couldn't do it. So if you ask me to paint the wall out there, I couldn't do it. So I would say, yes, it's going to be easy, no problem, go do it yourself. But, you know, I can't answer that question, I'm afraid.
Can I, that's you kind of, because you're a professional, I don't want to compromise you. So can I make an attempt? It's not advice, but what my thinking of working with craftspeople for quite a long time is that in the early days, if you build up a relationship with an agent, that you can grow and they grow an understanding of your business, in the long term, it's a very valuable investment. It's not expensive. If you have, as you say, very few transactions and it's small at the moment, if not this year, I think you should definitely next year be thinking of going to an agent and starting off in that foundation, because they will always notice something that you or me haven't noticed, and that'll probably save the modest fee, and it would be a modest fee if your transactions aren't great, you know, at this stage. And it's very important to get it right at the beginning. That would be my sense. If you get it right at the beginning, then you can build on a very solid foundation. So, Donal, do you have anything else to add to this?
No, I don't think so. I mean, other than the taxman shouldn't be feared. I mean, the biggest mistake we can make with the taxman is trying to ignore him. And don't ignore the taxman, be it income taxes or VAT returns or registrations, or, you know, lift the phone and talk to them. They're very difficult sometimes to get them, you know, and they won't answer the phone so well. But don't fear the taxman. Go and talk to them and stay in contact with the taxman. And you know, if you've got a difficulty with a payment, or if you've got a difficulty with a tax return, talk to them. They're reasonable people once they see you trying and making an effort. The thing the taxman, and particularly the way technology has gone, everything is now, you know, there's deadlines for everything. If you don't meet a deadline, you escalate to point A. If you don't meet that deadline, you go to point B. If you don't meet that deadline, next thing the sheriff is on your back. And you know, that's very unpleasant. So lift the phone, talk to the taxman, don't be afraid of him, and you'll have no problems.
Okay, I'm going to put one more question into you before I turn to Adriana. As a craftsperson, you may start off with one product / business. Later on, if you have a different product, stroke business, is that a different return? Can one be VAT registered and the other not?
Okay, no. You're either VAT registered under a particular tax number, or you are not. So it's either or in the case of a VAT registration. What a lot of people will do to get around that, they may have one trade under their own tax number, and they might register, okay, it could be a limited company, although that would be maybe excessive, but they might form a partnership. Again, they could form a partnership with their spouse or with a friend or with a family member. And again, the partnership would have a separate tax number. So in that way, you could have, you know, one business operating under the partnership number or the company number, and then the other business under your own individual number, and either of them can be VAT registered. So it can be done, but not under the one tax number.
Okay, and Donal, they're really getting their value out of you today. If you have two income streams, one service and one product, when do you have to register for VAT?
Oh, jeepers. Well, the service business would be 33,000 or there, but 33,000 and 33,000, 37,000. And the products one is 75,000. If neither business, I'm not sure, but I don't think you'd need to register for VAT unless one or the other exceeded the VAT totals. So if you did 60,000 on products and 20,000 on service, do you need to register that?
Yeah, 2 products. One VAT number, yes, you do.
You would, okay.
If the one VAT number, you're exceeding the threshold.
No, but if you have one service trade,
Yeah, but it's, you have one product under the one VAT number.
okay.
Yeah.
Okay, so if you exceed the product, if you exceed the 75, then you would have to register for VAT. But if you're under the 75, that's an interesting question now.
You'd elect to register.
Yeah, I would elect to register in that case. Yeah. Yeah, so if you're over either threshold, I would register.
Okay, that's a really interesting answer. The one going back there, you see where the craftsperson was saying here, that you start off with one product business and you later go on to a different product business. Can we just tease out slightly, Donal, and remind people that if they have 2 different types of work, if you have work that's maybe batch production and you have work that's more artistic and once off, one could go for artist exemption for a certain percentage of your work. Would you like to elaborate on that or just reiterate that?
Okay, so we're talking about income taxes now. So in income tax, yes, there is an artist exemption. So you would effectively have to do 2 sets of accounts or split your accounts and show the figures referring to your artistic work as one and your product or your manufacturing business or your what would you call it? Your craft business as another. And the profits relating to the artistic side, if they qualify for the artistic exemption, then that's fine, away you go. But the profits from the other business will be taxed in the normal way. So you would need to prepare accounts under the two headings. But that's no VAT is a separate question. The VAT is a different tax and a different, what they call a different tax head, and the rules relating to registering for VAT are different than those relating to income taxes. So the 2 questions are we have to deal with them separately. The VAT question is one, and the income tax is an entirely separate question.
Yeah, I just brought up the artist exemption because we hadn't, we hadn't squared it off or
Okay.
discussed it.
Yeah.
So, Adriana, do you have anything to add?
There was one thing I was going to ask, maybe check with Donal there about the VAT. I had heard at that seminar that I was at that did that weekend that if it seems that you're progressing through your first year of trading, let's say, and you're progressing through it and it seems as though you're going to get to the threshold, let's say, or by the way you're trading, that it looks like you're going to get to the threshold before the end of the year. Somebody in the room that day hadn't registered for VAT, and then by the time they got the end of the year, they had well exceeded it, and then the revenue came after them for all of it, going right back to the beginning. Is that accurate? It's worth noting, I think.
Yes, it is, and and it is one of those grey areas that can be hard on the taxpayer, because they didn't know it and they were busy making their sales and they were busy growing their business, and maybe weren't as aware of the regulation as they should have been, or as the regulation is. But yes, revenue have enormous powers, and yes, they can go back. So technically, you should register once it becomes clear that you're going to exceed those thresholds. So it's not like you go 360 days of the year and you're at 74,996, and then but if that was the case, you'd hold off a couple of sales into January. But you know what I mean? It is as soon as it becomes clear that you're going to break those thresholds, that's when you should be registering. Yeah, it can be penal on you if you don't.
That's great. I think we've covered an awful lot today. We've got an awful lot of questions going, and I hope that's given people, 1, the spur on, and 2, the confidence to face into getting your tax return done. And I'd like to thank everybody, and I'd like to thank you on behalf of the Enterprise and Marketing Department and Brian McGee and his team at the DCCI. We're going to be sending a survey out to everybody because we're really keen to build on the learning here, take a new departure, take all of your feedback. So we're serving your needs, and then I'd like to, with Brian, bring in different aspects and give it a new tangent, but you'll always be central. So if you bear with us, and when we send you out those questions, and add whatever you'd like, I think be very beneficial to us. I'd like to thank Adriana Doyle for being with us today. I'd like to thank Donal Horgan. I'd like to thank Brian McGee has popped in. So Brian, thank you for being here, and our audience today. So thank you very much, everyone. Thank you. Bye-bye.
Bye, guys.
Thank you.